This use of unlimited contracts for metal ownership in London effectively disconnected gold and silver's essential warning system of loose monetary policy, allowing central banks to inflate a series of asset bubbles in the largest global debt bubble in history. Tuesday, January 6, 2026, Monaco 64, home of alternative economics and contrarian views. Well, we're going to look at the bond market today, the government bond market, and not just treasuries, but also the Japanese market and the German market. And we're going to reference an article that David Jensen, who's a good friend of the channel, has just written. And I'll probably have him on soon as well to talk about it. But I thought it was a really good short article. It's entitled Loss of Control of Gold and Silver Price Fixing Scheme in London Leads to Kinetic Conflict. Interest rates will march and so are troops. Very good article. And he joins together the fact that gold and silver are so important for government bond markets and indirectly are so important to, well, at least keeping them under control is so important to keep the everything bubble going. But now everything's changing and we live in a completely different world that is feeling the convulsions, so to speak. And that's what we are going to look at. And I'm going to reference a pocketbook of gold because I think we're in the part where Jim Sinclair and Peter Carlin talk about gold being a revealer of falsely stated wealth. We are in it. And that's why we're going to continue to see higher gold and silver prices, not just in dollars, but every fiat currency out there, because this is not just a dollar problem, it's a system-wide problem. So let's start with the article and then we'll look at some charts and then we'll finish off here in a pocketbook of gold. So this article was written just a few hours ago. David is out in British Columbia, so he must have finished that late in the day on January 5th. So here we go. The run by investors into gold and silver during the 1970s, accompanied by selling of treasuries, yielded gold prices that increased 21 times and silver prices that increased 24 times over 9 years through to 1980, before interest rates were forced to 19%, thereby reversing the trend. Yes, Paul Volcker was the architect of that, and they could do that. Yes, there was a double dip recession in the early 80s, pretty bad one, but the debt load wasn't as great as it's now. I think it was 30% of GDP, maybe a little more, U.S. public debt. Now it's like approaching 125%, and not to talk about all the other debt out there. The Bank of England's gold and silver price fixing scheme that was started in 1987 with the introduction of trading gold and silver spot cash market unallocated promissory notes for immediate ownership and delivery of gold and silver bars at the world's largest cash gold and silver markets in the city of London, parked metal buyers in immediate ownership contracts that could be created without limit. Yeah, and as long as they didn't really want delivery, as long as they just kept it in the vaults, everything was fine, right? This use of unlimited contracts for metal ownership in London effectively disconnected gold and silver's essential warning system of loose monetary policy, allowing central banks to inflate a series of asset bubbles in the largest global debt bubble in history. So yeah, there you go. And now it's all reversing. We're going to see that in a minute. As metal shortage has compounded the pace of price ascension of these metals by winding down the London paper trade price fixing scheme, especially of silver, the growing likelihood of complete failure of London's gold and silver market with rapid global repricing of these metals accompanied by a rapid sell-off in bonds, which means, of course, much higher bond yields and interest rates, has not gone unnoticed. The cat is out of the bag on London's monetary metal price fixing debacle, and demand for these essential monetary, strategic, and safe haven metals is going to increase along with interest rates. Yes, and this is demand for the real thing, right? It's not a demand for London's promissory note, because the world's woken up to the fact that if they want real physical from London, yes, they might get it, but if there are too many people demanding it, then it collapses just like it has right now. This is historic, very amazing events here, I would say. America currently pays $1.2 trillion annually in interest for its federal debt alone. It's more than the military budget now. As interest rates led now by an accelerating sell-off in Japanese government bonds, globally continue to step higher, what is rearing its head is federal U.S. interest payments that could breach $2 trillion, then $4 trillion, and higher in short order. Rapidly higher interest rates globally, with global debt at $320 trillion, will be immensely painful. It was always known that rigging gold and silver in perfidious London would lead to global chaos, and here we are. The impact on the U.S. is going to be so severe that the government is going to be rapidly forced to switch its focus away from military matters overseas and even over its border to what is going on downtown. So that's an interesting opinion from David Jensen. Right now it feels like America is on top of the world, right? That it can do anything. But we could maybe not be far away from that scenario very quickly. This leaves a very short period now while the U.S. military is effective to grab assets. We're seeing it, Venezuela. And I think the Venezuela asset grab, it's about oil. And they want to keep the price of oil down. But the oil price has been going down for the last few years, and bond yields still going up. It also leaves a short period of time for those countries that for decades have used U.S. treasure and blood for their own purposes to try one more gambit. If President Trump allows it, let's see what happens. That's David Jensen there. And we're going to look at the bond yields now, because they're not behaving at all. Yes, they're kind of under control in the U.S. and Europe, but the direction of travel isn't great. They continue to rise. For example, the U.S. 10-year yield, it was at 3.6% back in September of 2024, when the Fed surprised the world with a 50 basis point cut in interest rates. That was the first cut, which we're still seeing cuts since then. And despite that, right now, that 10-year yield is around 4.2%. So it's actually gone up. The 30-year yield is approaching 5%. It's at 4.88. So I don't think the oil price is going to make any difference. It's all about the debt. It's all about gold and silver, of course, being the canary in the coal mine. They were able to keep gold and silver under control. And by they, I mean the central banks, the Fed, the Bank of England, the ECB, their bullion bank agents for many years through the LBMA, London, COMEX axis. But that is now all finished, as David Jensen was saying there. And talking about David Jensen again, I'm going to put my playlist that I have, David Jensen playlist, and you can listen to all the videos we've done about this topic. As gold and silver go higher, as interest rates or yields, because they can cut the short-term rate, but they can't control the long-term rate. As those continue to go up, it's going to be painful. And that's why you want hard assets, gold and silver. And talking about gold and silver, I just want to give a shout out to our friends at Dirty Man Safe, one of our affiliates. Well, what is Dirty Man Safe? Well, it's a way to hide, secure, and retrieve your valuables with ease. So I've got a link below in the description. And if you click on that link, it will take you to their website, and you can learn a little more about Dirty Man Safe and think about getting one to keep your valuables safe. So anyway, let's quickly look at these bond yields now. So I've got here the Japanese 30-year bond yield, and yes, that is at an all-time high, because they only started really issuing these bonds back in late 1999. So we've never seen it where it is right now. It's almost at 3.5%. And you might think that's still low, but I'll tell you where it was back in 2019. Well, it was at minus 0.2%. So the other thing as well, if you asked people in the financial sector, professionals, investors, fund managers, central bankers, if you ask them back towards the end of, or the beginning of 2022, when these yields were still below 1%, if they thought we're going to see 3.5–4% 30-year JGB yield in the next few years, they would have laughed at you. So I don't think they're laughing now, and they're very worried, and they don't know what to do. Eventually they'll learn that they'll have to buy gold and silver. So this is more than just the carry trade now. This is just a government bond, sovereign debt crisis. Yes, we had like a taster of that back in 2011, 2012 with the Southern European sovereign debt crisis. Now this is going to be global. It's going to, the biggest bond markets in the world are taking part in it, and it's going to, the contagion is going to be horrible. Bonds are not the place to be. Yeah, you might have a little bit of safety in short-term bills, but not anything longer than 2 years, I don't think, or not even 2 years. So here I've got, what have I got? Yeah, I got the Japanese 10-year yield. That's not doing great either yet. That has been trading for a lot longer, but it's at a 27-year high. And again, back in 2019, it was trading at minus yield, minus 0.31. So investors were so complacent that they would pay the Japanese government to lend them money. And why do they do that? Well, because when yields dropped like they did back then, the price of these securities went up very quickly. So it was more like a speculative bubble. They weren't buying for the fixed income. But now look where we are. Yet still really relatively low at 2.14 or 2.15, but it is at a 27-year high. Again, if you would ask someone a few years ago if this could happen, they would have said no. And I think we're going a lot higher. Now I'm going to bring up the German 30-year yield, and that's not looking good either. And those are the three biggest markets, US, Japan, and Germany, government bond markets. You've got Italy as well. We're just going to look at the top three today, but look at the 30-year, the Buxo, it's called, the 30-year German government bond. That's at 352, and it's the highest level in 15 years. And I think that's going to continue to rise. So now let's go back to a pocketbook of gold. A survival manual for monetary mayhem. And you notice that David Jensen used the word chaos, and I think it is monetary chaos as well, or monetary mayhem. So what gold and silver are going to reveal now is that all this everything bubble, all this 320 trillion in debt that has been conjured up out of thin air, that's all going to come, that's all going to crash in value, because gold and silver are going to reveal that these asset prices are falsely stated. So let's go through this here on page 70. And again, you can get a copy of this now on a PDF. It's $25. I think it's good value. And they haven't published a new edition of this, and it's really expensive to get these. So yeah, you can get one of these through the PDF. I'm going to put a link below in the description. So gold is a revealer of falsely stated wealth. When wealth is overstated and expectations for future wealth are unrealistic, fiat currencies depreciate. That depreciation is borne by the citizenry, who are forced to lower their living standards to compensate for both personal economic mismanagement as well as mismanagement of the affairs of state. Yeah, that's the affordability crisis, right? It's all to do with this bubble. And what I've been trying to do on this channel for the last 10 plus years is to warn you about this, and to make sure that you might manage your affairs in a good fashion so that you can survive through this mayhem and chaos. And having gold and silver, of course, is part of the survival mechanism. It isn't the end all, but it's a big part of it. Financial and military overextension has a social corollary in overpromised Social Security, Medicare, overstated real estate equities, affluence. As expense runs out of control, yeah, well, that's the interest expenses, right, with rising yields. Guarantees to the citizenry also explode as politicians seek to retain the privilege of office. So this is what the Trump administration is fighting, and that's why they're going around the world now, like arresting dictators and capturing their assets. That's why they're talking about sending people $2,000 checks, because they can see this coming. But the promises of wealth are false. The belief that ownership of real estate is a ticket to fortunes is hollowed out for what it is, a myth. Wealth that was taken for granted suddenly appears ephemeral. The amount of currency which once bought certain things no longer does, but wages have not risen along with prices. And yes, debasement of the currency is going to continue because I don't think these central bankers and politicians are going to allow this to just evolve very quickly. They're going to come out with the only tool they know how to use, more debt and more money printing, but that's going to debase the currency even more. Instead, well, they're cornered, right? Instead of wealth, citizens get saddled with a big chunk of government debt, i.e. debt created by mismanagement. The result is everyone pays more for food, fuel, and other necessities. So I guess with Venezuela, they're trying to lower that burden of the fuel costs. We'll see how that works, though. Government passes on the mismanagement of economic affairs to its citizens by devaluation. Well, that's what's happening now. A higher gold and silver price is devaluation. As the imprisoned money manager Martin Armstrong has artfully stated, and I quote here, and yeah, this book was written back in 2010. Martin Armstrong is not in prison anymore. But anyway, this is what Martin said. The decline in the value of a currency is in reality a free market tax taking away wealth that is overstated. So currency can also be an indirect tax to compensate for the poor management of the state, end quotes. The corresponding rise in gold, especially when it is a global phenomenon, as it is now, is in effect a devaluation of all the world's currencies and a restatement of wealth on a global scale. As is both presently and historically evident, the attempt to restate wealth to a lower level becomes a competitive event in its own right, as nations fight to devalue their currencies against each other to reduce the burden of indebtedness. It should be recalled that when FDR lowered the value of the dollar vis-a-vis gold in 1933, America was the 9th nation to do so in a 3-year period. Falsely stated and assumed wealth largely created out of the assumption of debts that cannot be borne must eventually meet at a lower level. Populations bear the restatement of wealth through the expansion of monetary aggregates, causing a devaluing of the national currency that denominates their wealth. This happens to all currency holders, regardless if they personally assumed any debt. Gold, and you can add silver as well, rises because gold is a monetary proxy inversely related to a nation's currency. The burden of indebtedness is reduced along with the standard of living. Commodity prices increase. Debt deflation has become currency inflation. They are one. So there you go. I'm going to stop right here. And so it's 7:45 a.m. London time as I speak here. And silver and gold are continuing to move up. Silver's up $2 actually at 78.63. The high has been 79.40. That's the spot price, of course. And gold is at 4,465, up $17. The high has been 4,475. So with that, I'm going to wish you all a very good day. Take care. Bye.